I think right now, probably the biggest bias that we're struggling with in some ways is kind of that like recency bias of everything that's in the news, and the constant news cycle of everything going on can make it feel like that short-term noise, like tariffs are such a huge deal on the economy, and they are a big deal on the economy. We don't want to minimize that. But at the end of the day, the stock market is going to continue to perform.
Welcome to a Wiser Retirement Podcast. Are you curious about how emotional investing can impact your portfolio? I'm Casey Smith. Today I'm joined by financial advisor Michaela Dowdy. Each week we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started. Hey, Michaela.
Hey, Casey.
So, Michaela, is this the first? No, this is the second podcast you've done now that you're an official financial advisor, no longer the planning associate.
Yes, I think so. You're correct.
For our listeners,
no, I think it might be more than that. I think this is my second one with you, but I did one with Shauna as well.
That's right.
Maybe it's
the third
three.
time around.
Mm-hmm.
So for those who have not met Michaela, she is highly sought after. People call up here all the time. Even people have been working with me for 20 years. They call me up and they say, is Michaela going to be in our meeting? Like, I don't know anything. It's crazy. Same with Shauna. Shauna was checking in on about 100 of our clients recently, and they're all like, well, as long as Michaela's at the meeting, yeah, we'll be happy to do a review. So you are, thanks for taking the time to do this podcast with me, first of all. And clearly you're in high demand.
Well, they're very kind to me. They're very kind. I do love our clients, so I'm glad that they feel the love as well.
So William last week got the F1 stories. Yes. We should have flipped that because you're the big F1 fan.
I am. I was actually kind of sad that I missed y'all's all your banter on that and all of your discussion on it. I wanted to peer through and listen.
Are you going to Austin?
I'm not yet. I mean, I haven't made the decision yet fully, but I don't think so.
Yeah. I don't think I want to do Las Vegas, but Austin's I'm kind of, I don't know. I enjoy the atmosphere, and it's a really cool place to hang out. It's definitely an event you want to take friends to, because it's not like a ball game. You go, you leave, or it's an all day event. It's an all weekend event, actually.
Yes.
I didn't go Friday. I went Saturday and Sunday, but yeah, so tempting to pitch the Wiser tent, because I've gotten so many comments through the last podcast, direct emails and text messages from our listeners, and they all were like, man, that's like the dream to go. And they're asking me if I'm going to Austin. I'm like, well, I didn't plan on going to Austin, but yeah, someone else who's really big in the F1 is like, hey, you and my son and I need to go with you guys to Austin. I'm like, why does everyone assume I'm going to Austin?
Because Austin is like the original American race, It's still, I think, the best one to go to because it is still very authentically F1 versus I feel like Miami's amazing, and so is Vegas for their own rights in and of themselves. But I feel like the true Formula One roots experience is truly I think at Circuit of the Americas. So Austin versus Miami and Vegas are very show stopping. But
yeah, I know the drivers have comments that they don't like Vegas just because it's in the streets, and even just the little, expansion gaps on the street really affects driving ability on the car going that fast.
Well, and they've had some major issues last year. Carlos Sainz had some major problems. A whole one of those sewer caps came up because they have so much downforce on their cars when they go over it with how fast they're driving that they didn't have it secured down enough as they were supposed to before the race, and it came up out of the ground and hit his car so badly that then I think he had to go to the hospital and everything else. But they were like, if it would have been worse, he could have been paralyzed. It was because of how hard it hit and everything.
Not only that, these people travel around the world. None of them are Americans. And you spend that much money and you lose a race or can't complete a race because the city didn't do their job right. That's awesome.
Exactly. Exactly. So it was a tough one, I think, last year, but I do think the racing was good in Vegas, surprisingly. But the time of the race is awful because it's 2 a.m. Eastern time, and it's still an hour country.
Oh, that's weird. Oh, because of the traffic and how they have to do things?
Yes. So they don't even start the race till 10 p.m. their time, like Vegas time.
Oh, that's when the
Mhm.
city wakes up. That's why they
Yeah,
have to do that.
exactly. You have all the lights.
That's morning in Vegas.
Hmm.
Yeah, I don't think I definitely not be going to that one. I've already seen the prices, and it's ridiculous.
Oh, yeah.
Um,
I think it's the most expensive race on the calendar.
and all it is a bunch of straightaways. They have a couple of turns, but pretty
Mhm.
much it's like 3 main straightaways.
Exactly.
So yeah, I guess they'd be going fast theoretically. Potholes don't get them, I guess. So there you go. We talked about F1 anyway.
There we go.
Um,
We had it.
all right. Well, first of all, if you're listening to this podcast, this episode, and you have not listened to part 1 of this, which is episode 284, you got to stop now. You got to go back to episode 284, Fear, Greed, and the Markets. And it's talking, we talk about all the things that human nature and all the biases that we have when it comes to our behavior and investing. And I did that with William, and we knew that episode's about 50 minutes. We knew that we could not do the problem and the solution all in one episode. So we divided and conquered. And Michaela here today is going to talk about how do we overcome our emotional biases when it comes to investing. So let's go ahead and dive in, and let's talk about. I want to give you guys actionable tools or routines or mindset frameworks to help you guys become more rational and effective as investors. And I posted on X this morning. My handle is Bullish Pilot. It's BUL. The I is actually a 1. SH Pilot, and we combined my love for finance and my love for aviation all into one. I'm trying not to love F1, Michaela, because I can't afford any more expensive hobbies.
True.
And
I
if you
think
go
that's
to
the most
Austin,
expensive
I'll
one.
give you a tip. If you go to Austin, buy your hat and buy your shirt before you go. It was ridiculous how expensive their stuff was.
Mhm. Oh, it's
Um,
insane. They mark it up. It's like an airport. The bottle of water is $30, you know.
Bullish Pilot on X. Make sure you follow me there. I'm just kind of getting started with all that, so I could use a few more followers to look legit. And I'll follow you back. I promise that. All right, so let's talk about starting with a plan, Michaela. I'll let you take it from here.
Yes. So when it comes to emotions, they can definitely get in the way. And I think something that as we go into this conversation today, I think it is important to realize that just like anything that you have in life, emotions are always going to be a part of something that you do. So while we may be saying, here's how to reduce your emotion or, not be as emotionally agitated or quickly triggered by certain events in the market, it is important to know that those emotions are not going to go away necessarily. It's more so of we're really establishing that framework today of, okay, well, because I know I'm going to have these emotions, let's talk through best strategies to mitigate those when they come up and when we're feeling that way. And so it's kind of like a therapeutic conversation in some ways. And in order to do that, I know this is going to sound cliche, but we do have to start with a plan. And it's
Yep.
starting with that plan of and having that forward approach of, okay, here's our action steps that we can take moving forward. And a lot of that, especially with investing, is understanding what investment policy you're wanting to enact for yourself. And that's where, your advisor kind of steps in there of how aggressive do you want to be in your investing? What is your risk tolerance? And what are those bands that you can kind of withstand in growth versus fixed income? And where are you at in your risk composure even? And that's something that I do love about we send out a risk questionnaire to all of our clients. And it is something that while that quiz can be a little, ambiguous on, well, how do you understand what it's asking and different things for clients? It is interesting though to see the scores come out as far as it goes to risk tolerance, risk composure, and those 3 different areas that we have around and surrounding risk. And really, it's that composure that can really, tug at our hearts the most in those conversations. But it's knowing that you have established, that plan. And I'm sure, Casey, you've seen this over the years of going through an investment or a plan and having that investment policy signed, and then going through and something happens in the market and it's, well, why am I invested, more into equities and fixed income and the market's doing this? And it's like, well, because your plan is built for every season of investing, not just this bad downfall market that we're in currently or whatever may be happening in the markets. And so it's important to know there is that balance there as well. So really just having that plan is huge.
And so we'll take it a step further. When you do a financial plan and you do one that is done properly, you already know what it takes to be successful. We typically use age 95. And what our software is doing is projecting the markets going forward. Mm-hmm. So that means that when the market's doing really, really well, our assumptions get more conservative. When the market's doing really, really poorly, our assumptions get more aggressive. And it's not a wild swing, but maybe within 0.5%, right? Mm-hmm. A deviation. And that's using forward-looking analytics. It's not Andrew doing this. It's there's 8 banks that track forward asset market class assumptions, mm-hmm. and they're using a component of that. It's not an even number. Some banks get more weighted than others, but that's basically what's happening. And then on top of that, we're looking at 1,000 different possible stock and bond market scenarios, returns going forward. And then we're looking at also a repeat of the financial crisis, which is the worst possible thing that happen, that happens right when you retire. And it's interesting, all the people some people on X, some people on the older platforms like Facebook, they're saying, oh man, I hate to be retiring right now. And they said this 3 weeks ago during this sell-off because of tariffs. Mm-hmm. We're kind of back to the break-even point now on all that. So that's now a non-event unless you sold, then it became a big event for you. But it's kind of like walking down the street you just look at your feet. You don't look up, or driving and looking at your Ford bumper. You're going to hit something. You're going to run into something. You're going to end up on somebody's TikTok, looking down at your feet, running the square into the telephone pole, Yes. So it's the investment policy statement is a reflection of your overall plan. It extracts mm-hmm. out the financial data or the performance data from your planning assumptions, and it puts it into a separate document that says, okay, these are the guardrails. And instead of panicking and selling because you're scared of tariffs, what we did, how we executed it was, oh my gosh, market's down 18%, bonds are up. Now our investment policy statement is out of compliance because we have more bonds than we do stock. Mm-hmm. Because we said, hey, we're going to be 60-40, and we allowed a 5% tolerance, and we could be 55 or we could be 65, but on stock. So what's happened is the stock became 55, the bonds became 45% of the portfolio. Okay, we're no longer in line with our investment policy statement, so that triggers a rebalance. And this is something that kind of came as a shock to me this time. Was when I said rebalance, we put in a couple of newsletters. People called in and said, "Yeah, I want to rebalance." I'm like, "Well, it's not quite time to do a rebalance." But in their brain, rebalance meant I want to redo, and I want to go from 60-40 to 45-55, right? Yeah. 45% stock. Mm-hmm. And that's not what you do in times of a crisis. You don't change your investment policy statement in times of a crisis. You had to put forth a thought prior to the crisis to say, this is the kind of volatility I want to take. And so, and it's much better to allow a client to lower the stock allocation than it is to go to cold hard cash. So sometimes we have to do that. We have to work our way back only to work our way forward, So, it's important. That's what a true investment policy statement is going to do for you. It's going to say, okay, these are my criteria. I'm sticking to this. Mm-hmm. And I'm not going to, and if it gets off the rails here one way or the other, then I'm going to bring it back to this is my objective. And that's exactly what we did. And what's amazing is how that process worked is we basically caught the bottom. It's a little luck to do that. Because who said that was going to be the bottom that day? But that was the day that the bonds were 5% higher. We sold bonds, we bought more stock. And then now we're 3 weeks out from that. And now everything's returned to normal. Now we're etching the other way. We're going to have too much stock and we're going to have to sell the 5% extra in stock and buy some more bonds. We literally bought low, sold high, right? Both times. We sold the bonds high. We bought the stock low. We sold the stock high. We bought the bond. We'll buy the bonds low on the flip side. And that's not what human nature does for you. That is a true investment policy statement, which every single one of our clients has, which we stick to the guidelines of. That's why it's so important to have those.
Exactly. And that's why you want to have those, is because in those moments, especially, it's even for any sort of decision you're going into. I know sometimes even if you're going into like some sort of, conversation with someone and you're like, well, we're negotiating this point. And if they say this, then I'm going to do this. And if they say this, then I'm going to do this. And it's like the same kind of aspect here where it's like, okay, we have these goals. And because of these goals that we have in mind for our future, we're going to have this investment policy statement. And if the market says this, we're still going to do this. And it's those kinds of different, avenues there. But it's also, talking in those tolerance bands of, okay, if the market does overperform here and get out of balance in the portfolio, then like we're going to rebalance that at this point, and it's very important to have those plans in place because of those emotions, because then you've already thought through it in your sensible mind beforehand to know exactly what you're going to be comfortable with moving forward from there. And I think that's where like that automation of, our next point of discipline. And it comes into having that disciplined mindset within your plan and making sure that you are staying disciplined in that, even in those tough seasons. And that can be really difficult, especially, I think right now, probably the biggest bias that we're struggling with in some ways is kind of that like recency bias of everything that's in the news, and the constant news cycle of everything going on can make it feel like that short-term noise, like tariffs are such a huge deal on the economy. And they are a big deal on the economy. We don't want to minimize that. But at the end of the day, the stock market is going to continue to perform. And so it's automating that discipline for even in those seasons where you do and no longer feel as confident as you were before. And, that's coming in from that automatic, even automatic rebalancing, like we're talking about, of rebalancing your portfolio, what that looks like, or looking at, dollar cost averaging into your accounts each, month at your paycheck, going ahead and paying yourself first, which we talk about constantly on the podcast. I feel like they're just making sure that you're, from that beginning get-go, going ahead and investing in yourself first and investing your assets, and then knowing, okay, now I've invested, I've set everything aside that puts me on target for my goals. The rest of this I can spend, and I can feel comfortable that my future is established for me already. And, of course, we're not going to say if you have a lump sum of cash received to dollar cost average that necessarily. Typically that is, it's best to just go ahead and get it in the market. But also in the sense of when you are just monthly or even bi-weekly, however often you get paid, investing into the market, those are huge ways to automate that. So you're not having to think about it all the time. Because if you're having to think about it, your emotions are going to come in. And that's where that temptation is going to have you remove those, steps that you have of, oh, well, let me invest this here. And if you're doing that manually every month, you're having to make that conscious decision. So it's really easy on those months you are, the market's not performing well and you're logging in and seeing your portfolio is actually down, to then be like, I'm not going to invest right now. Because it's way too volatile and I'm not comfortable with what the news is saying and what the short-term noise is. When in reality, the more you invest, the better that compounding's happening and the better off your overall portfolio is going to be. Before we jump back into the episode, do you know if you are ready to take off and launch into retirement? Get your pre-retirement checklist, a free guide from Wiser Wealth Management. From cash flow to Social Security, we've got your countdown covered. Go to wiserinvestor.com/guides to download your free guide today. Now let's get back to the episode.
That goes back to, how do you know to do that? I think the best people when they're DIYing it are the people they just do nothing, which is what so many advisors tell you to do. You don't do nothing. There's some things you can do, as we just discussed, but I think the biggest benefit of a financial advisor is helping you keep your emotions in check and make sure you're operating on the right information.
Mm-hmm.
Vanguard has a study. It's been done several years ago, but it's called The Advisor as Alpha. And alpha is basically outperforming. Look at it that way. What it was, most people would look at a portfolio, two portfolios, and say, okay, here's the index portfolio and here's the actively managed portfolio. What's the alpha of the actively managed, meaning how much are you regularly beating the indexes? Vanguard believes that active management doesn't necessarily have the a full fit into a portfolio, maybe partially in some areas, but most of the portfolio needs to be in the S&P 500 and be somewhat passive. But the advisor is alpha, meaning it's the advisor is making a difference. And so then their study, it's 100 pages long. I mean, it's a pretty good study. Shows that there's a 3% increase in rate of return from using a financial advisor versus people who don't. And that comes, and that's analyzed per year for the last, I think that was like 10 years. So the reason is not because the advisor is picking better funds. The reason is because the advisor has created a plan, is helping execute that plan and making sure people stay on the rails. And it's not something you advertise. That's something you say, hey, we're 3% better if you did it on your own. That's just what a study showed. Exactly. So and that's after fees. So in that, it makes sense.
I about that study. That's impressive.
An individual's rate of return over their lifetime is like 4%. And that's partially because of behavior. They call it the behavior gap, where you have 8% in the market, but then the average person gets 4%. And the difference is the behavior gap, because they do silly things like selling in tariff sell-offs and selling during the financial crisis. We met a lot of people in 2010 that had used to have $1 million. Now they had $500,000 in cash because they liquidated at the bottom of the crisis. Same way with the bubble.com crash, people liquidating or making bad investments and they go to zero, things like that. So using advisors as accountability is one way to overcome the biases as well.
Mm-hmm. Exactly. I think it's having that, third party to be able to take that objective approach, because it is something that, it can be very daunting to be looking at your own portfolio. And it's like, you're going into like some sort of like medical procedure and you're like, I am so stressed about this and I don't know anything. But then your doctor's like, I do this 6 times a day. It's not a big deal. Like, calm down. And I feel like we kind of have that same approach a little bit, where it's like, we're looking at plans and we're like, you are so good. Like yes, that this market is a little volatile. Yes, things are happening and it's moving, but that's not a bad thing for your portfolio necessarily, as long as you stay invested. And, right. You're going to be okay. We're going to come out on the other side of this. And we kind of have that third party, foresight a little bit of, hey, we're the objective approach here and we're promising you like, it's okay, know? And sure, maybe there's some adjustments that are made in the long term of some things, but at the end of the day, like, your portfolio is, going to continue to perform. And as long as you're staying in the market, it's, going to have those returns eventually rebound. And of course, that rebound time varies based on what's happening in the market. But I mean, even with this most recent one, I mean, it has not been very long at all as the tariffs have had time to now rebound back into the economy. So, we're back at where we were previously a little bit, like you've been saying, Casey. So it really is just having that third party approach to kind of come in and say, hey, reminder, here's your, vision and plan that you've set up. and it's okay. And we've already accommodated for this conservatively in your plan, in knowing that we've already applied the worst case scenario and you're still okay. And that is a huge, huge benefit.
What are some mental frameworks that we can use to help with this?
Mm-hmm. Well, I think it's understanding that it's a long-term runway for everything. It can seem very short-term when you're in the thick of everything, and it can feel like, oh my gosh, the sky is falling right now. But if you actually look at your long-term picture, you have to realize that there are so many more goals that you have oriented in your planning. There is so much that you have going on in retirement or before retirement even, and, continuing to save, and that really having that long-term focus and understanding that, even in, I think y'all spoke on this at the last podcast, but even just talking through, like, if you are coming out of the market in 10 to 20 days of those best days, then you're going to cut your returns in half. And that's like such an important thing to realize, that the long-term approach to investing is so, so important. Because if you're trying to apply, short-term principles, like a long-term plan, it's not going to work out well for you, in the sense of you want to make sure you're consistently staying invested, and not, having those emotions come into play, and understanding that there is a long-term approach here, and understanding the bigger picture. And even, sometimes, they talk about you can't see the forest for the trees a little bit, and understanding that just because of something that's right in front of you, that doesn't mean it's the big picture. And it's sometimes taking that big picture into the grand scheme of things, because, like life, we all have little blips, and, we all have moments where we're like, oh my gosh, my world is caving in, and it maybe has nothing to do with the stock market. Maybe it's a relationship. Maybe it's, something going on in your career. And if you really look at that in the longevity of your life, that ends up being such a blip, even though at the moment it was such a detrimental part and such a big part of your story. But that doesn't mean that it was a constant catastrophic event for you. And so that's just something to note, is, having that long-term approach instead of looking at that short-term mindset, and understanding that there's so many more goals and everything that you've already planned for ahead, and to not get, swindled by those short-term struggles. And even going into, sometimes looking at the big thing, you kind of talk about in like life decisions, like, well, will you think about it in 5 years? Will it be a big deal in 5 years? And then the other thing is kind of taking the sleep test, which is what we kind of have on this outline here, is applying that. And it's saying, would, this decision keep you up at night? Is this going to continue to keep you up at night? And I think there is a great, balance to that as well. Is sometimes, yes, it can be tough to sleep if, the market's not doing well and you're really wanting to be in cash, and feel like that's the safest option, even though it's realizing those losses. And it is important to understand that while, yes, there might be some anxiety associated with that, it's also knowing that, even if it's going to maybe make you a little stressed, maybe it is still better for your plan to stay invested. And so I think that can be something to balance, definitely, of like, would this keep you up at night, in the sense of, if you were to say, I'm realizing these losses and I'm not going to earn them back, maybe that's the better question to be asking yourself. Does that still make you feel better? Are you still going to sleep at night, from that, conversation with yourself? And so I think those are kind of those conversations to have with your own emotions in some ways. And of course, like we're saying, pulling in your advisor into those conversations is huge. Because it's like therapy. And we joke all the time, we're therapists, partially, because money is such a difficult and emotional conversation to have. And it is a huge, huge part of our lives. And so it can be very daunting to talk about. And it's something that, of course, we hope at Wiser, we're able to provide a peace and calm and understanding about finances. But it is something that we know for the broader world, beyond our bubble of financial planning, it can be very difficult to talk about. And so we do want to be mindful of that. But it is just taking those overall and taking that zoomed out approach and understanding that long-term investing.
Yeah, I think market corrections are normal. Mm-hmm. And we've kind of gone through a really good 10-year stretch overall, but we've had moments of 10% corrections, a 20% correction, I believe one time in the last 10 years. and well, I guess more than that, because that would have COVID data in it still. But the point is that the markets move up, left to right, and the more you zoom out, the more obvious the line is. We go through these periods. We get politics seep into our investment portfolios, and we do silly things with our emotions. And fear is a great motivator. If you're fearful of something, we've had clients in the past that are no longer with us that unfortunately just couldn't overcome their fear. They were so wrapped up in the news that they got. We had one that I think got all their political or all their investment news came from The View. Like, there's not one single analyst on there that knows anything about money other than maybe how to spend it.
Yes, they were not having their investment advisors on those, or financial advisors on those calls.
No. And it was just all this fear, and it crept in so much that portfolio liquidation was the only solution. And I'm like, I'm not doing that. I'm not going to be responsible for the downfall of your entire financial stability for the rest of your life. So it's maddening because you want to save everybody, but not everybody wants to be saved.
Yes, exactly.
Right.
Like, and it's doing that hard work, kind of like how you have to do in therapy, where you're like, oh my goodness, I actually have to work through this thought process that I continue to keep telling myself is reality. And it's realizing you have to remind yourself it's not.
If you have a plan in place and you're in a low cost, diversified portfolio, the best thing you can do is not even watch any of this. I mean, I would say I glance at the Wall Street Journal. It's on my iPad. I get it digitally. I have Bloomberg up in my office that has just tons of information on it, and I get a glance of what's happening in the market that day, maybe why it's happening, so I can do podcasts and talk to people. But I do not spend every hour trying to figure out where the market's going to be 3 months from now. I don't care where it is 3 months from now. I care where it is between my age now and age 95 for every single one of our clients. Some people are closer to 95 than others. And then some people we have to use 100 or 105 because moms are 101 or whatever. But the point is that it's like, what are we doing long term? And then how do we mitigate risk? So if you're buying individual stocks, you should have some anxiety because your stock could be an Enron. Your stock could be a Google. Your stock could be a NVIDIA. There's so many different ways this could go with individual stocks. But when you own 6,700 stocks and your largest holding is 1.25% of the entire portfolio and everything else is fractions of a percent, there's just nothing that you should allow anyone to steal your joy over. Go out there and keep earning money, do what you're good at, or if you're retired, go do the things you've been meaning to do for the last 20, 30 years, 40 years, whatever. So it's I don't want to make light of it because I employ a whole person here. Andrew, the king of data, is in charge of all this stuff, right? So there is someone here that is in this stuff every single day. He gets paid to do that, but we're not making decisions off of that information. So it's just, but again, when I told William in the last podcast, it's like that whole scenario. I went to a conference one time and the guy's like, how many of you here are good drivers? And everyone in the room raises their hand except for maybe a couple of people. He's like, well, that's an example of how biased we are because there's about 2,000 of you in this room right now. And statistically, 60% of you have been in a car accident that was your fault.
Real. That overconfidence definitely creeps in big time.
So yeah.
Yes. We always love to think that we have the best perspective.
Right. So just remember, you've got to take advantage of these situations. I mean, the clients who took advantage of the last 3 weeks are way ahead of the ones that were fearful. Way ahead. We had a couple of people reduced their equity allocations reluctantly. And it doesn't look very good. That doesn't look like a very good decision right now. But for those that say, hey, this is an opportunity, I got to figure out ways to get more into the market right now. They're looking pretty good, especially on the crypto front. Crypto came rearing. Actually, crypto didn't go down as much as the overall market, but it is now back above 100,000. Bitcoin is. Of course, I say that now. Tomorrow it could be at 85. It's so volatile.
True. You never know.
That's just where we are today. So I would say that, emotional mastery is a lifelong journey. This is not something that you get fixed overnight. Say, oh yeah, listen to this podcast, and yeah, I'm not going to get emotional about this. This is how we're wired as humans. So everything we're doing and talking about today is fighting human nature. Typically, education solves that, and that's something that I'm very passionate about. Is that we're educating our clients on why things are going on the way they are, and why we're doing what we're doing as a firm. And if I can educate people on that, then they understand, and then they can live a much freer life. Fortunately and unfortunately, a lot of our clients just don't care. They hire us to do it. And so I get all excited about this, and their eyes kind of glaze over. But the engineers and the pilots who are kind of like quasi-engineer, they definitely seem to dive in a little more into the weeds, which is what I love, because as a fee-only advisor, we have nothing to hide. So our job is to educate. I feel like that our client base has weathered at least Tariff 1.0 pretty well, and has done the last 10 years very well. Not from a performance level, yes, but mostly just from a quality of life perspective of having a plan in place and living with a little more confidence in their future.
Well, and I think that confidence is even shown in the way that when the market is performing, not as ideally as we would like, I feel like a lot of advisors kind of struggle with, clients constantly calling them and freaking out. And it typically comes from like people not being fully educated on what's going on in the markets, and they don't understand themselves and feel confident themselves on what their plan is projected out to be necessarily. Whereas I feel like at Wiser, sure, we have phone calls. It is not like people do not call us. They definitely do. But I mean, as far as a percentage for how many clients we have, it's relatively minimal compared to definitely what it could be. And I think that is contributed to hugely and largely because of the fact that a lot of our clients do have that understanding that the markets are going to continue to perform regardless of, what goes on in the short term, noise and everything. But the market will rebound eventually, and there will be, returns again in that long-term outlook. And that's just, exactly that emotional mastery and just having confidence in that historical perspective.
All right. Thank you, Michaela. Great conversation. Thank you, listeners, for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation, meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com. You can also click on the episode show notes. Don't forget, episode 284. This is part 1. Make sure you listen to that. And we will see you on the next episode. Thanks for listening.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.